The difference between investing and trading, we have to separate the two. I would either be getting in this zone as it's coming up during this period here.
Hello everyone, it's Alessio. Now in this video, I'm joined here by our good friend Charlie Burton, as you can see here, looking nice and fit, much fitter than me, obviously. This is going to be quite an interesting video because I'm going to ask Charlie essentially the strategy or indeed the methodology he uses to position size and average, for example, averaging down, or indeed how he goes about the strategy he uses to essentially go long or buy into a position. Let's say as an example, if price is coming down, this could be anything by the way, this could be Bitcoin, stock markets, individual stocks, or even gold, whatever you like. But what are the strategies a trader could use to position size and get long or buy into a position? So it's going to be quite an interesting video. Join us. All right, guys, welcome back. So as you can see here, I'm joined here by my friend Charlie Burton. Charlie Burton, of course, needs no introduction. Some of you already know. You've probably seen my previous videos. He's been a trader and chart analyst for nearly 24 years. And one thing I haven't really asked Charlie, at least I don't think I have. Charlie, how did you start? I mean, I know you've been trading now for over 20 years, but what made you get interested? Maybe you can briefly explain how you got interested in the trading game in the first place. What was the inspiration for you to say, yeah, this is something I want to do?
Well, I worked in financial services anyway, so I worked for a fund management company, and so I used to advise financial advisors on funds and the likes. But fund management is a very different thing to trading. So I was effectively like a regional sales manager, looking after financial advisors. But because I was involved in that, of course, my colleagues in the City of London would always hear about shares and certain stocks that sounded quite interesting, that might be doing well. Bearing in mind, this is in the sort of 1996, 97. Stocks were doing, that fantastic bull run, generally speaking, apart from a little blip in 98. But so that's what got my initial interest, was just literally getting share tips off of my colleagues. We were all hearing various things from the funds and the likes. So that's what got my initial interest. Bought some shares and did quite well. And then it just so happened that one of my financial advisors said to me one day, I've got some tickets to go to some trading event to learn to trade the options markets in America. Would you like, I've got a free ticket. Do you want to come along? I said, yeah, great. And that's how it happened. Like many people, although I worked in the professional environment for fund management, I actually went on effectively like a trading course and learned to, certainly that was my first introduction into buying stocks with a methodology of buying the stocks, looking at fundamental analysis, technical analysis, and also writing covered calls on them. So that was my introduction into it, and then gradually went from there.
Thanks, Charlie. So what I would like to ask you, let's imagine a trader, let's say a beginner trader, whatever, wants to, let's say, average down, and let's say his account size, we'll just say 10,000 as an example, keeping it simple. Let's say he's got a $10,000 or 10,000 pound size for his capital, and let's say he wants to average down, okay, or indeed scale in or position size. So can you show us visually how you could go about doing that as an example?
Yeah, absolutely. So I'm going to be turning away here whilst I'm looking at the screen here. So this is simple blank chart. It's not of anything. Yeah. It's just a simple chart here. So actually what I'm going to do is I'm going to take this zone over here. Hopefully that arrow is coming through. I can't tell.
Yeah. No, we can see it. We can see it.
Right. Okay. So let's assume that you're putting it to me about adding to a position. So let's take this period here where it's pulled back. So for argument's sake, let's say I've identified this zone here, which is these prior highs here, as a buy point. So I want to buy on a pullback. So I'll just clear this drawing a little bit and then just put it back on again. So I want to buy this pullback here, let's say. So that's where I might want to put half a position in. And we can't see enough going back historically here, but let's just play the game that for whatever reason, I also want to add a half down here. So I get filled, I put an order in, and as price comes down, obviously I get filled on this half, but then price starts to move away from me. So price starts to move away from me at this point in my second order. So my second order never gets filled. So this is where I would say, okay, I've got filled on this first half. I'm quite happy to add as price starts then coming up, and I'll get my other half position in somewhere during this phase. This is how I would look at it. It's actually, it's respected this support zone here. So then I would then start to look to add during this. If this hasn't worked down here, so it's not got me in down here, so I would then add here. I'd probably, looking at this chart, I'd be moving my stop up to below these lows and add another half in here. Looks like it then retraced a bit, but it wouldn't stop me out because my stop loss is down here. And then I would just be riding this for this run. It doesn't matter if this is a daily chart here we're looking at, or an hourly chart. It doesn't matter if you're an intraday trader or what the time frame trader is, or if it's a weekly chart. It doesn't really matter. But that would be the philosophy that I would have.
Just a question. So my question is on the second trade, when you're saying it doesn't hit, the one that's moving up, would you be buying the breakout of resistance or a pullback as it's going up, or does it matter at all? I mean, which does it really matter? What is your preference, breakout or a pullback after breaks out?
Normally I'd be looking at by the time it's broken out up there. I don't always like breakouts. I don't mind breakouts if we've had multiple tests of an area. So if it keeps on. So if it had been like this test, and then breaking out, that would be the sort of, yes, I'd buy that type of breakout. But more of a single peak breakout, I'm not as bothered about. So I would either be getting in, let me just turn the pen off so I can clear it up a little bit. I would either be getting in this zone as it's coming up during this period here, before it's even actually got to the breakout. That's how I would look at it. Or if I haven't, and I've let it break out first and then pull back, then I would then, looking at this, yes, my stop loss at this stage might be down below this low down here, but again, that was looks like it was quite a sharp pullback. So if I hadn't yet added my second half, I'd probably be looking at this, and if I've got an order in to buy, fine. But if I was actually just manually waiting to see it settle, I would again be looking during this phase when it starts lifting back up again through here. So, but again, before it's even got to that prior high, most likely. So a lot of the time I'm going with it as price starts moving up. That's when I'm saying, okay, it's showing me the love, as I use the expression. It's going in my direction now. I've got a course, smaller position in, and now I'm ready to add to that position.
Sounds good. I'm sure this question may come up. Probably someone will ask this question, which is that, okay, let's say you ride that rally, nice trend going up. Let's say hit that 42 level on the chart you got there at the peak, at the next peak. Yeah. The question may come up, well, what if you apply the same exact strategy now, let's say waiting for a pullback? Let's assume that you are even looking for a pullback to buy. But the question may be, well, how are you going to protect yourself against the massive loss which could incur in a situation like that on the way down? What would you go about doing that?
Well, we use stop losses, don't we? So as traders, so
True.
This is what I'm saying. The difference between investing and trading, we have to separate the two. Because if I was a long-term investor, this might be, I don't know, an index tracker or a fund or whatever, and I'm just putting money aside or into my fund or an ETF on a monthly or quarterly basis. But
yeah,
we don't need to worry about that type of short-term volatility we're investing into funds, because we might be looking to hold our funds for the next 10, 20, 30 years before we're actually drawing on it. And we know that we have reasonable certainty that if we invest today, that in 30 years time, the markets will be higher than they are today. We know with the benefit of history of 200 years, hundreds of years of stock market history, that would be pretty unlucky if we were to invest today and 30 years later be underwater. So that's investing. So again, we're talking about trading. When we're talking about trading, we have to have stop losses. So we have to pick our levels where we're going to buy, and then we're going to have to then have a level where we're going to have a stop loss. So it doesn't matter if it comes to, if I was looking at this chart, or if I was buying on this chart, and let's say I had a buy point.
Let's say that first dip from 42 to 38. Yeah, let's go with that one.
Yeah. Okay. So what you were saying there is, if I was looking to buy over here somewhere, yeah.
Yeah. What if you had a second order at slightly lower?
Maybe 34 from this congestion point, maybe. So yeah, even if I had a second order, so I'm going to put half position size in here and half position size in here, and somewhere below that I have to have a technical stop loss. So let's say my stop loss is there. I'm going to get stopped out. I lose 1%. I move on. What's the concern? What's the worry?
Right.
And that's the thing to, as far as traders are concerned, positional traders, if they have to use stop losses. If you're a longer term positional holder, then you're holding for a much longer term, then that's different, as I've just said, as if you're more an investor. But if you're a trader, then you've got to have a point where you're going to cut the trade, and you can't just be like those masses where they get into trades, it goes underwater, and this happens around the world all of the time. My asset managers, I'm a money manager, they talk to me about, they see it happen all the time. Brokers that I use tell me about what happens with their clients, and all around the world we see the same picture, that the masses tend to get into trades without stop losses because they want to be right a lot of the time. They don't want to accept being wrong, and then if price comes down against them, they just add in indiscriminately. There's one thing adding in, like we're showing, professionally adding in with a given plan, preempted where we're going to be adding into a trade. And there's another thing where you just say, right, I'm going into the market here. Oh, it's going against me. Oh, I better add some more to average in. No, that is not what we're talking about here. That's what blows up people's accounts when they do that sort of thing.
And I presume, going to your chart, let's say the second one, half. Let's say you add your second half there, then you get a little bit of a bounce, presumably on that. Presumably you could put just your stop loss beneath the last bounce, the low before the bounce.
Oh yeah, absolutely. I was just making up that on the chart there, but yeah, absolutely. That would be a good technical level to have the stop loss there. Yeah, absolutely.
Or I suppose another method would be, like, you could draw a trend line connecting those lows, and if it breaks that trend line on the right-hand side, that's another way you could limit the loss. Yeah, thanks, Charlie.
Sort of along there.
Yeah, and a break of that trend line could be the level. You could say, okay, you know what, this is not acting like I thought it should.
Oh, absolutely. I quite often use trend lines and stop losses, have stop losses below trend lines. Also, like yourself, I will have stop losses below moving averages as well.
Yeah.
Other people might have stop losses below Fibonacci levels, of course. And so it's not always just technical levels, but I think in many regards, it doesn't matter what your level is. The point is, you've done some analysis and you've got a plan as to what your entry is and where your overall exit's going to be, whether it's an exit for a profit or it's an exit for a loss, i.e. a stop loss, a point where you say, right, at that point, I get cut out of the position.
Okay, thank you so much, Charlie. That was really educational and interesting. And guys, I hope this video has been of some help to you as well. If it has, please give it a like. And we'll see Charlie hopefully in the future.
Guys, one final thing. Make sure you watch my members video, the members video I posted just recently, because we covered a lot of detail, both about the Elliott wave counts and the potential very important key levels on the stock markets and Bitcoin, also gold as well, and much more in the members video. And if you're not a member, you can join on that link you see right there, and I'll put the link for in the description. By the way, that link gives you 3 months extra free of membership, so that's a total of 6 months. And guys, I look forward to seeing you in the next video update.